So ladies and gentlemen, welcome back to the channel. We're going to get into some things that we did not talk about in the last video that I think you also need to hear. Now, some of the things that we're going to cover, we're going to look at the option bubble chart. We're going to look at how some positioning is for the next couple of weeks. But I also want to get into some of the economic data for this upcoming week and how that could affect the markets as well. Kind of give you a crash update, if you will. Look at some of the treasuries, how they reacted on Friday. Is this downside move in the markets really over? Now, why I think it's important that you guys really watch the last video that was put out today before this one is it'll connect the dots a little bit more. In the last video, we went over why I think AMC stock is likely to go through a big rally. Now, the markets, though, if they fall, if we do go through another downside move, that's not going to be a positive, most likely, for AMC. There's always the off chance that AMC stock does do well when the markets don't. But you can't count on that, okay? Don't count on that, having that inverse reaction to the markets. Lately, AMC stock has been following the markets, but it's done very, very well. So I think there's some things we need to get into. This week is action-packed as far as economic data, some very big data that you guys need to know. So let's go ahead and get into it. Hit the like button and subscribe to the channel and source your comments, questions, or concerns down below in the comment section. If you guys want to come trade with us as well, live in real time, I send out the alerts every time I make trades. We're hedging portfolios. We're making some YOLOs, some long-term investments. We're doing everything over there. Link down below in the description of this video. And like I said in the last video too, if you guys have signed up and you did not get a link sent, message me. Let me know. Comment in the comments. Let me know. Okay. You can go to the channel as well. Go click on the channel info. You can email me, and we'll get you taken care of, because sometimes it doesn't work. So I don't know who it doesn't work for, if that makes sense. So let's go ahead and just jump right into it, guys. So like I said, kind of in the last video, everything looks really good for AMC. On a technical basis, looks like you'll continue to break out, especially if you get above about 20 cents higher from here, around at $9.50. That's a sweet spot. If you get above $10 per share, that is even better. But again, just to rehash a little bit of the last video, you're not buying AMC stock or making a trade on this during the hype. There's like no hype in AMC, right? So you never want to go into a trade already, being the one that's kind of FOMOing in, right? That's buying after the rally already starts. You want to be positioned before the rally. And I think this is the time right before the rally. So I do think this, long story short, can set us up for a $20, $30, $40, $50 share price of AMC stock. There's obviously dilution risk, but I think that's less of a risk when you are going through a big rally. A lot of the time when companies do dilute after going through a big rally, it does affect the stock negatively for a couple of days, but then people get over it and the rally usually continues. Usually the dilution, if you get it from a company during a big rally, it's usually not the high of that rally, right? You usually will continue higher. Just fundamentally speaking, if you dilute shareholders, it's not great. But if you do it after your stock went parabolic, that's better than not. And some analysts actually like that and will start to raise price targets. But maybe that's a topic for another video. Everything looks great with AMC. Now, as you guys know, Taylor Swift just helped AMC notch its highest ever single-day ticket revenue in its 103-year history. So I'm sure this is part of the reason why Friday AMC stock was up over 12%, including the move in after hours. You're up almost 13% on Friday alone. That was a very big move. Likely we'll continue to see that upside momentum as well. Now, if we take a look at the Ortex data here, go ahead and take a look at the option activity before we dive into what's happening out there in our markets. Give you a little bit of a crash update. If we pull up the options, we look at this week, October 13th, blow this up as a bubble chart. You'll see that a lot of the option activity on Friday was around this $9 call. You did see about 15,000, almost 16,000 for volume. That was by far the most active option out there. The 950 call seen about 13,000 for open interest. The $10 call, or not open interest but volume, the $10 call had about 13,000 for volume. The 850 call had about 6,500 for volume. The only active puts you'll really find are the 750 put. That has open interest of about 11,000, seen volume of 9,000. And for the $8 put, that is open interest of 8,000, seen volume of about 14,000. So the calls are definitely outweighing the puts. You see this in the puts call ratio as well. As I reported in the last video, puts call ratio went down to 0.75. So that's another thesis that I have. You never really seen a multi 100% rally when the puts call ratio was extremely high, when there was a lot of puts on AMC stock. It was just, that just usually doesn't happen. Stocks usually don't rally hundreds of percents if there is, 2 to 3 times the amount of puts relative to calls. Well, now you've seen that plummet back down to more normal levels for AMC, and now you're getting more calls than puts, so that obviously can have an upside effect, as well as the seasonality of just this season tends to be pretty bullish, at least the second half of October and November and December. And the risk to reward, again, you could fall back to $7 per share. Sure, that's like a $2, 30-cent drop or whatnot. But you could rally to $20 or $30. So that's very much not a position you want to be in if you are a short seller. Now, I think the number one potential risk for this rally in AMC is probably the broader markets. And what we've seen on Friday was weird, because what has been dominating our markets is the bond yields. Now, really on your 10, 20, 30-year bonds, the Fed has very little impact on those yields. When the Fed raises rates, they affect a 1-month bond, a 3-month bond, a 6-month bond, a 1-year bond, a 2-year bond. Though that's really what the Fed is manipulating. They have been saying higher for longer for a long time, trying to get the 10, 20, 30-year bonds to react to that. They didn't have much luck with that. Bonds were not reacting for a very long time. They're like, you're gonna have to cut. It's fine. We're not gonna sell those bonds too much. We're not gonna drive up the yields. But what has happened recently is the bond market started to actually listen to the Fed, and to some degree, the bond market ran with it. And this is because the economic data has been coming out really good. And the bond market, long story short, is saying we're going to be higher forever. If the Fed is not buying bonds and supporting bond yields, then what do you evaluate the government as, right? As far as being risky or not risky? Or just think about it like this. 15, 20 years ago, before the Fed was actually buying bonds, like 20 years ago, and supporting lower interest rates by actively buying the bonds, the government was in a much healthier spot than where we are today. Think government debt, think servicing that debt, right? Think the political atmosphere we're in, government shutdowns, right? People don't even believe, what's going on out there in the government. I'm not going to get into, the politics here of all of it, but you guys can understand what I'm saying here. The government's a lot more risky, I would imagine, now than they were 15 or 20 years ago. So that is not great for bond yields. The riskier you are, the higher yields you need to pay out. That's why the U.S. has been so fortunate with having low yields for such a long time. Obviously, part of it was the Fed. Part of it is because we are a lot less risky than other countries out there. But if you're going to stay higher for longer and the Fed might not support the bond market for a very long time, the Fed has no control over the 10, 20, 30-year bonds that really affect the economy. Think a mortgage loan. I'm going to get another rental property here soon. Just trying to find one, I guess, is the big problem. But the lender was telling me they just go 2 to 3% higher than the 10-year. So if the 10-year goes to 5%, then your mortgage rates are 7.5% to 8%, which is basically where we are right now. If the 10-year goes higher than that because you're getting runaway expectations of where yields are going and maybe some speculation, some shorts in the bond market, well, that has a big impact on the real economy. When the Fed raises rates, it's a trickle-down kind of effect on the economy, right? When the markets themselves start to raise yields on the 10, 20, 30-year, that puts a lot of pressure on the economy. So the Fed has kind of walked some of that back, some of the higher for longer tonnage, verbiage. They've basically said Fed Dally, which is interesting because Fed Dally, Fed Collins, those are two of the most hawkish members right now on the Fed. And they've been saying maybe we won't need to cut rates. And then you've seen this rapid rise in the 30-year Treasury. And now they're like, yeah, you shouldn't assume we're going to be, higher forever, or rates are going to stay this high. So it's interesting, the kind of flip-flop that they have been doing. But what we seen on Friday was the 30-year Treasury was actually up 7 basis points. So when the Treasury yields have been rising, stocks have been down. On any given normal day that we have seen recently, 7 basis point rise in the 30-year Treasury would have caused probably a 1+% down day for the indexes. That did not happen. Your 20-year Treasury was also up about 9 basis points. Again, that would have caused like a 1.5% down move. And your 10-year Treasury yields were up about 8 basis points today. So the trend has not changed. The economic data came out good. The payroll report came out way hotter than expectations. Yield soared, but stocks also soared as well. I personally think this is a oversold bounce that we've seen. If you take a look at the S&P 500, you were at the most oversold levels that you have been at since back here in October of 2022 when stocks were much lower, when the selling had gotten very dramatic. So now that the RSI is off of that 30 band, you're sitting right here at about 43.5. I would be very cautious sitting here saying, hey, Friday was the end of this recent pullback. It might just still be the start. The same trend has been playing along. Yields went higher on Friday. Just the only difference is stocks went higher as well, which is not what we have seen recently. So it's a little bit wobbly out there. Now, this week is dominated with Fed speakers. Monday as well, a bunch of Fed speakers. Pull this up on your computers, on your phones, whatever you use to trade, so you guys can have this at your disposal. It's free, tradingeconomics.com/calendar. Just do trading calendar or economic calendar, trading economics. You'll find it. It's very easy to find. This is by far the best one. Now, on Tuesday, you're not going to get much for economic data as well. You're going to get wholesale inventories and consumer inflation expectations. Those come out at 10 o'clock and 11 a.m. Eastern Standard Time. And then on Wednesday, you are going to get PPI month over month for September. I think the core PPI is a little bit more important. PPI recently has been high because of energy. So if core does rise, that's not going to be great. Core's been staying right at about 0.2% for like the last almost a year now. It's been pretty stable here. So you want to see, does that go higher now, or does that stay the same, or even potentially go lower? So that's the big catalyst. That'll be at 8:30 in the morning on Wednesday. The FOMC minutes, that's a transcript of the last Fed meeting. We may or may not get more details on why the Fed did what they did, maybe what some of their plans are. So you want to be watching that, but doesn't always give us the biggest move. Now on Thursday, that's where you're going to get your big economic data. The CPI report. Now, core inflation rate month over month is expected at 0.3%, the same as last month, a little bit higher than where the Fed wants it, but it's been low recently. Recently, you've been like 0.2 for June, July. August was 0.3. So if we fall back down to like 0.2, that's going to be great. Unfortunately, the price of energy rising, it's not calculated in the core, but things that are calculated in the core are affected by energy. Basically, everything you touch is affected by energy, right? If you're a store, you have a storefront, your energy bill is likely going up, right? If you have to transport anything, any product, and literally any product that you have right now, this cup was transported. This phone was transported. This pack of Cheez-Its Extra Toasty was transported. This painted on Xbox controller was transported. I did not manufacture that in my house. So it's affecting everything. So that's something to be watching for. Now, inflation rate month over month, your headline is expected to fall a lot from 0.6 to 0.3. Your inflation rate year over year is expected to fall from 3.7 to 3.6. So you're expecting some good news on the front of inflation. If that happens, that's great. The lower, the better. And if we do get low enough, the yields are high enough where the Fed might not need to raise rates again. They can start to be a little bit more on the dovish side, if you will. Now, Thursday, you're also going to get the Chinese inflation rate. That comes out at 9:30 p.m. And China's recently been in deflationary territory. That is not good. So you want to see, does China continue to see a little bit more inflation, or do they continue to see a little bit of deflation, which deflation is way worse than inflation. So keep that on your radar. And then the Michigan Consumer Sentiment Survey, big thing you want to watch here is obviously what's the sentiment of the consumer. That'll tell you a lot about the economy. It usually, I've noticed, revolves around the market. So if the markets are doing well, consumer confidence is high. If the markets are doing poorly, consumer confidence is usually poor. That's why you bottomed out back there in October with a consumer confidence around like 50, 49, 48, and you peaked out back in October of 2021. I feel like a lot of it does have to do with the markets, but that's something the markets will pay attention to at 10 o'clock in the morning on Friday, but also the 5-year and the 1-year inflation expectations. 5-year inflation expectations actually fell a lot recently from about 3.2% down to about 2.8%. You're expecting that to fall to 2.7%. That's what the Fed wants to see. That's what you want to see. Now, the inflation expectations for the 1 year not falling nearly as much, still sitting at about 3.1%. If you can get a move down to the 2s there, markets are probably going to like that. But any hot economic data that we get, a hotter inflation report, yeah, could cause a 5, 10, 15% down move in the markets. If we start to get core that really is not going down, that is picking up, maybe core comes in at 0.5%. Then the bond market's going to say, yeah, we are definitely going to be higher forever, and we're going to sell off stocks. So I would just be a little bit careful with some of this bullishness we got in the markets on Friday. I don't think this story is over, even though stocks actually went up as bond yields also went up. Now, this could have a big effect on AMC. If, stocks fall, that could be really bad. If stocks do rally, though, if you're a bull on AMC, that could be big. That could send AMC stock well into the 20s, 30s, 40s, or 50s, just depending on the degree of bullishness. Some investors out there, some hedge fund managers like a Dan Ives, he just came out with a note on Friday and said he expects tech stocks to rally 12 to 15%. If tech stocks rally 12 to 15% by the end of this year or in the beginning of 2024, AMC stock likely going along for that ride. Considering everything we talked about in this video, and especially in the last video, well, that could be very substantial. So that's going to go ahead and do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.